Did you know that you are 4 times more likely to need disability insurance than life insurance? Well, many people know that they need to cover their loved ones with life insurance in case something should happen to them. But a lot of people don't think about the more likely option of disability insurance. So today I'm going to talk about the differences between short term and long term disability, what the tax advantages of on how you elect how the premium is paid, and then specifically dive into what own occupation means versus any occupation. And hopefully you'll find this very useful in your open enrollment period. So why does disability insurance matter? 1 in 4 workers will experience a disabling condition before retirement age. And this is attributed by Social Security Administration. And 1 in 8 workers will experience a disability that will take them out of the workforce for 5 or more years. That's 12.5% of the workforce. So if you look around even a cubicle farm, at least one of you will experience at least a disability lasting 5 years or more. That's why this is so important. And recent studies have shown that term life insurance, only 2% of those policies ever pay out because there isn't ever a death. But the disability policies, those are being used at an excessively high rate compared to a term life insurance. So it's even more critical that you have disability insurance. Your income is by far your greatest asset, so it's time to protect it. Short term disability is something like if you get a long term illness that is going to take you out, let's say a few weeks, all the way up to 6 months. And it typically covers about 40 to 70% of your income. Now, the waiting period is usually 0 to 14 days. So that's generally covered by sick days. So let's say you get a long term illness, those first 14 days can be covered by sick days. But anything beyond that 14 days, that's kind of when that short term disability insurance is going to kick in. And often, this short term disability is just entirely employer provided. Now, long term disability will kick in after your short term disability has expired. This is generally going to cover 50 to 70% of that income. And the reason being is an insurance company is never going to provide you more than 100% because then there's no advantage to you going back to work. So it's always going to be less. And then if you think about it, at least probably 20 to 30% of your income may be absorbed by Social Security taxes, Medicare taxes, and federal taxes. So you don't even need 100% of your income to be replaced. You probably only need that 50 to 70%. This benefit period, it depends on the policy, but it could be 2 years, it could be 5 years, it could be 10 years, or it could be all the way to age 65. So you kind of have to look through the policies because it is important that you have something that could stretch all the way to that age 65. A 2 year policy might not be long enough for you. And again, this waiting period is generally 90 to 180 days. A lot of these go all the way to the 180-day period, and they won't kick in until that short-term disability has expired. This is how taxation works on disability insurance. So if your employer pays the premium, then those are going to be paid with pre-tax dollars, and the benefit is going to be taxed. Now, for the long-term disability, a lot of times you're given the option as to whether you should pay those with before or after tax dollars. These premiums are not exceptionally high. So if you pay them with post-tax dollars, they're generally just a few dollars more expensive, roughly that 22% more expensive. But think about it is now, because you've paid with the post-tax dollars, now any benefits that you get will not be taxed. So you may pay a small premium, but when you get a benefit from it, all of that money is not going to be taxed. And that's going to go a long way if you're only getting 50 to 70% of your income is now, because it's not taxed, that's going to go a lot farther. So when you have that election, strongly consider electing them have it be post-tax dollar. Another key aspect of disability insurance is own versus any occupation. So in own occupation, that means that if you are disabled, then you will be able to collect on those benefits as long as you are not able to be employed in that same occupation. So this is critical if you're in a highly paid professional job. Let's say a lawyer or a doctor or a veterinarian or a highly technical engineer. You want to make sure that you have a own occupation policy because you don't want to be able to get a much lower paying job and have that offset your benefits. Any occupation means that you can get a job in any occupation out there. It doesn't have to necessarily be the job that you were injured or when you got sick. It doesn't have to be that same job. It can be any job and those will either offset or fully take away any benefits. So be careful with this one, especially if you're in your high paying job. Now let's talk about employer policies versus private policies. So generally your employer group plans are going to have some pretty good rates. They're going to be relatively low. They may even be free. Your employer may pay for it. Now realize again, if your employer does pay for it, those will be with pre-tax dollars and the benefit will be paid out with tax due. Now, if the employer pays it, it's probably worth it to just go ahead and take that risk. A lot of times these are automatic enrollment, and these are not going to be portable when you leave your job. When you leave your job, this policy is also going to leave with it. Now, an individual policy is something that you go out and purchase on your own on the open market. You own and you control this policy. So when you leave your job or at retirement, this policy is going to go with you. The good news on this is most likely these premiums are going to be paid post-tax. So meaning that all of those benefits are going to come to you tax-free. It likely will be a higher cost and it likely will require medical underwriting. So these are some things to consider on an individual policy. So what are the key takeaways for these disability policies? So you're more likely to need disability than term life insurance. Now, don't get me wrong, you likely need term life insurance, but you definitely need disability insurance because you're 4 times more likely to need it. It's also important to know how those benefits, if you ever do need them, are going to be taxed. And again, target that 60 to 70% of the income that is going to be tax-free, and you'll be right on line with what you were getting with a full income. And you need to coordinate those dates between your short-term and your long-term. You don't want a short-term that expires at the 90-day mark and a long-term that doesn't kick in until 1 year, because now you have a 9-month gap that you have to cover out of pocket. All right, so here are the actions that you need to take today. So you need to review your benefit options, review those open enrollment documents and see what are you eligible for, and does it cover at least that 50%, preferably closer to the 60 to 70%, but at least covers the 50%. And then see, does it give you an option to pay that pre-tax or post-tax? And then update your selections. Make sure that you do that during open enrollment, which is probably open right now, and strongly consider that post-tax option. And if that policy is not greater than 60% or more, then you may want to consider some private options. I hope you enjoyed today's video. If you liked it, go ahead and give me a thumbs up and go ahead and subscribe so you can watch more videos like this. And if you have any comments, throw them in the comment section below. And if you've got a great idea for a new video or something that you want to know about, go ahead and throw it down in the comment section and I'll review that and see if I can't make a video for you. I really appreciate your time today.
Information provided in this video is for educational and informational purposes only and does not constitute financial, investment, tax, or legal advice. I am not your financial advisor, and you should consult with a qualified professional before making any financial decisions. All investments involve risks, including the potential loss of principal. Past performance is not indicative of future results. This video does not endorse any specific investment or strategy. By watching this video, you agree that I am not responsible for any financial outcomes based on the information provided.